It's interesting when you look at the recession dashboard here, when you're looking at layoffs, a crunch in a business investment, when you're looking at simply how much spending ability the average American has, and then kind of combine that with what the market is actually pricing in. Joe, is this what a recession feels like?
Hi, Kriti. Thanks for having me on. I think right now we really have we're kind of in flux because traditionally this is not what a recession feels like. There's usually more job loss that companies that. But right now, I think that, we had the first quarter, which printed a negative number, GDP. This quarter, we're possibly most likely going to do it as well, which is a technical recession to an extent. I guess Mike has already said earlier that we've never had a recession without two consecutive negative quarters. But I think right now we have consumers. We've had a fair amount of demand destruction. So I know when we talk about gasoline prices rolling over, that's rolling over because you've gotten to a point where demand has been crushed. So I think on the margin, is this a typical recession? Not in a typical sense, but I think what we are seeing right now is probably more of a shallower, not as long in duration recession.
Yeah. Okay, so Joe, where are we in the cycle? We've just seen data from the ISM, the services number, which Ira Jersey described as mid-cycle. Are we still mid-cycle? And if so, how do I invest if it's mid-cycle? Are we late cycle? If it's late cycle, am I correctly positioned? If I'm in a recession, how do I want to position for that? Where do you think we are in the cycle? What does the data tell you? And where do you want to be positioned for where you think the answer to that question is?
Yes. I think that we have to take a step back and realize that the data is never perfect. There's never any indication. There's no one that rings the bell at the top or at the bottom. So I think right now we're probably, the way that if you look at the equity market, especially coming out of last quarter, stocks are pretty much discounting that we're past late cycle and we're into a downturn. And the last thing to shoot a fall was energy, because as we went through the year, energy was the only sector that has positive returns. And then, last month, we started seeing this degradation in returns of not only the equities, but also in the commodities. So I think that the market, at least from the equity market standpoint, is getting to a point that we're past the late cycle. We're on the verge of the downturn. And I think that's kind of also reconciled when you look at the fixed income market with the yield curve flattening now actually to a point of inversion. So we're taking, triangulating all of those things, it seems that it's more likely for investors to start positioning themselves for a slighter, a downturn that won't be long in duration. So with that, I think you've had consumer staples and healthcare and utilities. Those names have already been priced up. Investors have gone out and bought insurance, and that's why these names are trading at such a high multiple to the market. So right now, we're thinking the opportunity actually lies in some of the earlier cycle names, but obviously more tactically. So when we're thinking about more consumer discretionary and financials there.
So, Joe, I'm interested to know what actually investors need to see to turn this around. I guess I'm wondering more of, you have so many different components as you do for a recession. You have an extremely tight labor market. You have a shrinkage in the workforce to some extent. You have a shrinkage in business investment. You're already seeing that with a lot of these tech companies, even Wall Street banks kind of slowing down some of their hiring and even laying people off. In addition to a major housing shortage, I'm curious at what point or what data point are investors most glued to when it comes to either predicting the end of the recession or predicting the depth of it?
That's a very good question, Kriti, and there's no perfect answer for that. I think right now investors are really, front and center on investors' mind is what the Fed's going to do. The whole adage is don't fight the Fed. The Fed has been raising rates this entire year. The equity market has had negative returns. The fixed income market is as well. I do think that there's definitely correlation there. So right now, it really, I think investors are waiting to see if the Fed will make a policy error. And I think right now, we're factoring in, they'll do 75 basis points this month. And hopefully, our hope is that, they will see what, inflation numbers come in like over the next couple of months, also payroll numbers, and in September, take the opportunity to have a pause. Now, that's what we're hoping for. Obviously, hope is not a strategy. So I think the market is really more concerned on if the Fed is going to make a mistake and tip us too far, and that will actually give us more of an indication of if this is going to be a longer slowdown or not.
Joe, Brent's now down below $100 a barrel. That's the first time that's happened since April the 25th. The energy trade that everybody's relied on so far this year to deliver is now turning around. If energy's not delivering, how do I avoid losing money in this market? Where can I actually hide out? Because the places are far and few between.
No, you're absolutely right, and that goes back to my earlier point that, we kind of needed to see energy roll over to suggest that we have actually moved past the late cycle, because energy and materials, those names are generally later cycle names that hold up well when we're in a higher inflationary environment. So what the market is suggesting is that inflation has peaked. We are moving past those later cycle names because demand has either been destroyed on the margin, or that there is just going to be a lot slower growth. So right now, what we're thinking about positioning wise is consumer discretionary names, because when you look at these names, a lot of these names are trading similar to where they were in 2020. When the economy and the globe was completely shut down. They're trading close to book value. So, and similar to financial. So we think that those names are already overly discounting a major slowdown, and that's where the opportunities are.